Investors are telling emerging brands they must be omnichannel. At the same time, big box retailers are fighting negative comps and need new brands to drive traffic. TikTok brands are going from 0 to 10 million seemingly overnight. And somewhere in the middle of all that hype is a little less glamorous question. Who pays for the inventory? My guest today is Aaron Wall, founder of Lunr, a retail-focused capital partner built specifically for the moment when a brand lands the PO and realizes that selling in is the easy part. Aaron spent nearly a decade as a buyer at Target, then worked as a broker at Bluebird, and what she kept seeing was the same pattern. Incredible brands landing massive retail opportunities and then panicking when the $5 million purchase order hits. In this episode, we break down why sell-in is not success, sell-through is, the biggest mistakes brands make walking into their first buyer meeting, why you should build digitally first, but not wait too long to build retail relationships, how retailers are aggressively courting TikTok native brands earlier than ever, when to use a broker and when to go direct to a buyer, the financial traps brands underestimate, including slotting, promos, chargebacks, carrying costs, why debt is not a commodity and why your capital partner's behavior matters when forecasts miss, a case study on scaling into Target, Whole Foods, Walmart, and Costco without blowing out the balance sheet, and why we'll fix your margins later is a dangerous assumption in retail. This is one of the most tactical conversations we've had on retail. If you're thinking about entering Target, Walmart, Sephora, Whole Foods, or you've just landed your first big PO, this episode will likely save you real money. Welcome to In the Money, an exploration of whether you can still make money in D2C and CPG. We talk to some of the most interesting $5 million to $50 million founders, operators, investors, and acquirers in the space to ultimately answer the question, is D2C and CPG still a good business? Hope you'll enjoy the show. Aaron, I'm so excited to have you on. I think emerging brands are at such an interesting point. Even the investors that I've talked to on this pod have pushed for omni-channel, saying that they're only writing checks to omni-channel brands. Some people have called it the death of D2C. That's on the one hand. On the other hand, you have large retailers, Target especially, but even Walmart experiencing real pressure, negative sales comps, naturally has downstream consequences for brands. So are we bullish or bearish on emerging brands entering retail?
Great question. This industry is evolving so quickly, and there's no question that what I would have told you 2 years ago about building your best direct-to-consumer presence and getting to know that, individual consumers so well before you even talk to retail and having a really compelling UGC marketing story is now for sure evolving. And I think there are a lot of reasons for that. I think we could use retail as a more broad term right now. So what we're seeing in our best case scenarios are brands have already gone to sell digitally, right? And so that could be you built a really solid direct consumer business, or it could be that you kicked off your brand through a mixture of TikTok and Amazon. And you've driven, somewhere between $2 to $4 million digitally alone. You're still getting to know that consumer pretty closely and intimately and directly. You're still figuring out how to drive sales directly. But now you know what your best sellers are. You know the right pricing strategy. And the next move is obviously going to be, okay, how do I take this brand and I sell it off a shelf in a Target or a Walmart or a Whole Foods or Ulta or Sephora? So I think that's where I'd go right now is I'd say, build a digital footprint, build a following, and then start taking it to these retailers. What I didn't address was kind of what's happening in retail. And I know, a lot of people are wondering right now, where are we at? What are the retailers that are worth going to first? What we're seeing is all of the retailers want you first. They want you to, drive in-store traffic for them. They want you to be a exclusive, potentially partner. Could be by SKU, like David Bard just did, where they launched individual flavors at each retailer. Or could be by brand, just saying we want your entire brand to be exclusive to us for multiple, years potentially, depending on the retailer. But they all need you and they need you pretty quickly. And so we're seeing a much faster transition specifically from TikTok, typically, where retailers are just reaching out directly and getting after these brands when they're pretty small.
And if you're a brand you've got velocity, maybe you've even hit 5 million in either D2C or TikTok and Amazon in your first year, should you be spending energy to meet buyers, or should you focus on D2C and let them come to you, into your DMs, it sounds like, even sometimes?
Yeah. So the retail cycle is incredibly long. I think brands underestimate that. And if they wait too long, they're waiting for the next transition cycle, which sometimes could be a year from when you had your first interaction. So I always think you want to show up where these retailers are early. They would need to know you exist. They need to know why they would want you. And you may even want to start a relationship well before you're ready for an on shelf experience. But then you'll know, right? You'll know where you fit. And this is coming I was a buyer at Target for 9 years. So as a former merchant, I want people to come to me and know exactly where they fit in my pricing strategy. I don't want to have to tell them that their price is too high and we're going to be promoting it every day. Those are the kind of things that you want to figure out very quickly. I know Sephora does a great job of kind of cultivating these relationships early, and they do that through all of these events. And I mean, it's like every retailer has their own strategy for this, which we've been tracking closely as well, just because they even vacillate on how much they invest in these kind of incubator models and how early and when to bring them in and what information do they need to have to be successful as a part of like our retail ecosystem.
Yeah, interesting. And then for a brand interested in getting into retail, I know it would depend on retailer, so feel free to be general or specific, but should step one be in a broker? Should step one be directly to the buyer? I know that we were talking about Expo West in pre-recording. Should it be a trade show? Like, what's kind of step one, or is it all of the above?
I think it depends by retailer for sure. I think finding a direct path to communication with the buyer is always probably a great first step if you can get really direct feedback from the buyer on where you sit. Oftentimes, I see people asking the buyer directly which broker or rep they want to work with, especially in the bigger ecosystems like Bentonville and Minneapolis, where there's a lot of options. And what you need and want might look different depending on who you are. So I get asked all the time, I want a one man shop. I want somebody who's going to treat my brand like gold and I'm going to be a top priority for them versus a huge rep firm where I know I'm never gonna be their top priority. They've got huge fish to fry. They just got Athletic Greens and, whatever David Bar into Target. Like, that's not I'm never gonna be important to them. So, I think it's finding that right person, and I think, finding people you trust to help you and guide you in even that partnership. But I was just down in Bentonville, and I used to think Walmart was a not a big rep firm city. Now it's gone the other way where they're grown so much and they've kept their team so lean that they continue to need that support behind the scenes. And these buyers want you to have somebody helping them because they don't have time to answer all of your early stage questions that aren't necessarily important to their day-to-day business driving initiatives, right? They need to stay focused on that stuff. And you're going to use your broker for all of those dumb questions, everything you need to do to get the item set up. What are the right promo strategies? How do I test? What is my fulfillment strategy across each channel? All that kind of stuff is really the role of the broker and then getting you paid ultimately.
If you are serious about the economics of every order, this one's worth paying attention to. Rocked After-Sell is a leading post-purchase optimization system running from cart to thank you page. Smart checkout offers, one-click upsells, all of it connected, all of it working together. Brands like Hexclad, Jones Road, True Classic are seeing up to 30% revenue per visitor lift without touching their acquisition spend. But here's what the best growth teams are doing in 2026. They're not just squeezing more revenue per order, they're monetizing the real estate they already own. Rocked Thanks turns your confirmation page into a pure profit line with premium, non-competing offers matched by Rock's Brain AI. We're talking 30 cents to 50 cents per order straight to contribution margin. So at 50,000 orders a month, that's up to 25,000 in found profit every month from a page your customers are already landing on. Works on every platform, no contract, launch today. Go to aftersell.com/exclusive to claim your exclusive offer and start unlocking incremental revenue on every order. The brand gets the coveted pitch meeting What is maybe something that's not quite appreciated for an emerging brand that's in that pitch meeting for the first time that they really should be getting across?
It's a really good question. Kind of going back to my buyer and broker days, I feel like I can tell immediately how well researched a founder is on the existing assortment, both digitally and physically, right? So, my number one by far is if you walk into that meeting and you don't know every single one of your competitors, all of the different store formats, how they sit on the shelf, what their typical pricing and promo strategies are. You haven't done enough research and you shouldn't have a retailer meeting, is generally how I feel. And I think that goes way beyond. I mean, even down to, you answer the question for them of by ounce, are you a better value? They're not going to run the math in their head and they might not know, but you're the expert and you're the only expert in your product. I think another thing people forget about is making sure they answer any potential concerns in that meeting, right? So if it's like regulatory and you have a product that makes claims, know exactly which claims you're making and that you've done your work from a regulatory perspective, right? Don't let the retailers try to figure that out. Or even worse, don't let it get to shelf and then get it pulled because you didn't do the work, right? So those are the type of things that I think to the earlier point of coming in too early and not having an answer for all of those things is what I see sometimes happening. And it's like, at that point, you should just step back, head down on the digital business, continue to drive a consumer and continue to learn if you're not ready for those type of questions at an, initial meeting. Um, yeah. And I've seen it all. I've seen every error possible. And I mean, I can even speak to, now from a Lunr perspective, we're taking an enormous amount of risk, right? We're bringing in capital at the time of commitment from these retailers. So we want to know that you've actually made the product, shipped it, and proven consumer demand before we will ever advance you a dollar, right? And every single time we've advanced a dollar before those things happen, it doesn't work. There's an issue in production, there's an issue in shipping, there's an issue upon delivery, or there's an issue once it hits shelf with pricing and sell through. So it's a really those are the type of things I think people just underestimate. They're like, I'll figure it out when I get there. And it's like, yeah, there's a lot of details behind that.
What are perfect segue to kind of track to Lunr and where it sits in the ecosystem? So, like you mentioned, nearly a decade experience as a buyer and merchant at Target. You're seeing founders come in, grow almost overnight from $1 million to $10 million in revenue. They're trying to figure out the kind of working capital mechanisms on the fly. You're now running a team at Lunr. Just maybe tell us a little bit about the positioning of Lunr. I know you mentioned kind of at that PO commitment, but where does Lunr fit in that cycle?
Sure, sure. Yeah. So a little on the backstory. I was a broker after I left Target at the Bluebird Group, and I was seeing these incredible brands come to me, and they were going from $1 to $20 million in revenue at Target overnight. A lot of them had celebrity backing. I mean, they were like hitting all the marks at the time of the things you'd want to see. And as soon as I would come to them and I go, hey, congrats, I got you an end cap for Q4. So it's going to be $6 million. You need to start production today. That was sort of when I would see their eyes like glaze over and there'd be like a look of panic instead of excitement. That's always when I'm like, what was going on? Why? So started to dig in. Obviously, now I understand it better from a, back end looking at their P&L perspective. But these brands might be doing $5 million in revenue over the last 12 months. They might have raised $1 million or $2 million in equity even. So, all signs are really going well. But then when you get a $5 million order, where does that cash come from? There aren't a lot of equity investors that are interested in investing in dollars just to buy inventory. At the time, there was maybe you could maybe go get a little venture debt from SVB, which obviously doesn't exist anymore. And so there was just this really big gap. It was really early, kind of early stage financing when you're just doing direct to consumer, kind of revenue based financing, kind of give and go model, and then a huge gap before you're able to go to a bank. And the other like incredible positive about filling this gap from a Lunr perspective is we're actually like we're putting more equity dollars and equity shares back into the founders' pockets, because instead of fundraising at a time when you're pre-retail, now you can fundraise when you've actually seen sell through and you've had that end cap, and it's a much better time, just in terms of your longevity and your ability to utilize that capital more effectively too.
You mentioned earlier that Lunr only wants to deploy when there are some proof points, some customer affinity. Maybe let's click into that a bit more. Like, what does Lunr's underwriting look like? And I presume that the founders can actually get a lot out of this in terms of like what will success ultimately look like. They come to you with a PO in hand from a big box retailer. Is that enough? It sounds like maybe not. Like, what else are you looking for?
Yeah. So our entire team is former retail founders and retail investment bankers. So having a retailer behind you and give you a PO is like just the beginning of opening up a box about all of the things that it means to be successful. So the number one message I want to tell founders is sell in is not success. Sell in is actually the easiest part of the entire journey. It's the sell through that determines the real success. So our team takes such a hard look at what the sell through could mean. So we start with, we have to have the samples. We touch, we feel, we use, we bring them home. We trial all the food, all the beverages. I was just sampling a beverage right before this. It was like a really unique mouthfeel. And we make sure that as a consumer, an everyday consumer who's actively out there shopping, that it kind of checks all the boxes. We also check on the price point and the packaging. Like, we've been burned before where we didn't ask to see it. We maybe tried it in like a sample form, but we didn't actually get to see what's the weight of this? How is it going to sit really in the protein section against these huge containers from Vital Proteins? Those are the kind of questions you have to ask to like validate a sell through. But we also built technology between our seed and our Series A where we now connect directly. It's a really, really easy underwriting in terms of the founder side of things, where we connect directly through our app to their bank accounts and QuickBooks. And I think what people don't think through is like, we're looking at every transaction. We're going back and culling the past to make sure that the story they're telling matches what we see. And it's easy to get caught up in like, the future is so bright. But in this business, we're really looking for like, do you really understand what your true margin is and your contribution margin? Like, have you dug into the components of that and what it will really look like when you're doing it at scale? And a lot of people don't really think through, carrying costs. Like, how expensive is it going to be when you need to have it sit at your 3PL with multiple weeks of supply for Walmart over time, or when you're buying raw materials at bulk because Walmart wants you to keep 6 months of supply because you're a private label supplier. These are like real financial scenario planning that we're doing behind the scenes. And I mean, at the end of the day, the amount of underwriting we do, a lot of it too is about like, our like, does this business make financial sense over time? And I mean, Fan, you've looked at some of these businesses. It's like, it might not be a direct line to profitability in the next 6 months like everyone dreams of, but do you understand how it's going to operate and run on the current cash constraints it's set with? And I think those are two different answers that everyone should be constantly thinking about, that doesn't require equity over time, because equity is a nice to have. It's not a guarantee. Like, these equity investors they're getting so tight. They're being so picky. They see thousands of birds. And so we don't necessarily fund a company going like, there's no question you're going to raise a Series A. We fund a company going, could this business survive if they did it?
It sounds like you're almost a consulting practice wrapped around a lender. It sounds like you're thinking about this kind of as thoroughly, if not more thoroughly, than the founder and sometimes even the investor is.
Yeah, absolutely. There is a part of our business that's probably the really where, rubber hits the road, which is these founders get full access to all the things we're saying. So when we do analysis on our founders' business, we hand it over to them. We show them, like, this is what you're paying, and this is why we see in the next 3 months your margins are going to start deteriorating if you don't do something. Or this is how we're looking at your another huge one is looking at vendor terms. Like, I think people don't spend enough time looking at these retailer terms and really understanding them, and every component of them and how they affect the margin over time. So we spend a lot of time with that. And a lot of times we're just answering, questions for these founders, helping them dig in and go, all right, so if Costco says they're going to pay me early and I said I'd pay 1%, what does that actually cost in dollars? And these are just, you know, big picture kind of questions that I think it's easy in the moment. You're super excited about a retailer. You're signing on you're like, whatever it takes, I'm getting into Costco, I'm making it big today. But the reality is there's a lot of other little detailed questions that are great to ask. And we're always happy to help with it.
Most founders treat subscriptions as a marketing tactic. The best ones treat it as a capital structure decision. Here's why that matters. Recurring revenue changes your multiple. It changes how lenders look at you and how acquirers underwrite you, and how much runway you actually have when things get tight. Predictable cash is the asset, not the size of your customer file. Recharge is the subscription platform serious e-commerce operators actually use. It gives you the visibility and control to run subscriptions like a business unit. Subscriber behavior, churn management, retention flows, built for operators who think in contribution margin, not conversion rate. Recharge runs on Shopify, and with it, you can launch and optimize subscriptions fast and convert one-time buys into recurring revenue. Brands like ButcherBox, Harry's, and Ritual are built on it. If you're building something worth acquiring or worth keeping, subscriptions aren't optional. They're your defensibility. Go to getrecharge.com. That's GETRECHARGE.com. Most founders, I think, treat debt as somewhat of a commodity. Show me the volume, show me the rate. You have a strong view that founders should be as selective about their debt partners as their equity investors. Tell us more about that.
Yeah, I think in this question, I think I'd love to give an example because we have had so many amazing founders where things don't work out exactly as they planned. And one of our companies was going into Walmart. They're going to do private label bars, kind of competing against some pretty big players. Walmart had put together a formulation that was incredibly clean and didn't taste as good. So guess what happened? The forecast did not pan out the way they thought. And they had gone in and gone all in on 6 months of raw materials, right? And this is super common. Retailers are not they're not experts either. That you think their forecasting mechanisms are so good. There is a certain amount of constant balance when you're on the retailer side of trying to use the information you have and give these brands a best forecast possible, but it's a forecast, and that's exactly what it is. And even once a PO is written, it can be canceled because things change, right? And so in this case, this partner of ours ended up incredibly long. We had paid for all that inventory. So guess what happens? Comes back to me and, it's like, okay, I don't even know how we could possibly pay you guys at this point because we're sitting on 6 months of raw materials for Walmart on a formulation that isn't working. And this is just where I think if you're going to go and partner with anyone who supplies you the capital to grow, you should have talked to 3 or 4 other brands who've used them to know if they're ever going to pull that capital, if they're ever going to not be your partner going forward, if things go poorly, how do they behave? Because we've heard the stories of other capital providers in this debt space that they don't treat people like partners. They're the first ones to yank the capital and your growth strategy is gone. You don't have any capital to buy any more inventory. You can't go expand your account. You can't expand into other retailers. And they don't really understand retail enough to know why, or they can't even ask the right questions to help you get through these tough times, right? So in this case, what we ended up doing was we ended up working with him really closely. We were like, okay, we're going to use all these other retailer opportunities you have. We're going to put together a payment plan. We're going to continue to work through the inventory. We're going to kind of focus on what we can drive at Walmart just from like a weeks of supply and an ownership. And we helped him with thinking of negotiation tactics, even around payment strategies with Walmart. And it was almost probably a year long over from start to finish situation. But guess what? He's great, continuing to grow, able to go and find another debt partner at the end of all of this that fit the new model. And I think, that's just kind of the way this business is you can't predict where it's going to go. And in everyone's even in Walmart's best case scenario of coming up with a cleaner option, that probably was the right thing to do on paper, but on shelf and in a consumer's mind when they're rebuying it, doesn't taste as good. Guess what? So, yeah, that's just one example.
Yeah, fascinating. Are there one or two brands in the Lunr portfolio that the audience might know? And if are there any attributes that you can tease out of why they've done well?
Yeah. Well, the one that I know we've published some case studies on is Chia Smash. And I don't know if you've heard of them, but they're a chia based jam or jelly product that you can use that's much lower in sugar for your, peanut butter and jelly for your kids. They've come out with some incredible tasting snacks and almost like a toastable Pop Tart like version that is all like low sugar, much better for you. And I think what made this brand so special and what made our partnership so special is they were operating really lean. These founders were husband and wife duo. They're probably the smartest people I've ever worked with, and they were figuring it out every day. But when you're operating lean in those early days and you're, heading toward profitability, what do you need? You need incredible partners who help like support this lean team. So it could be, people with financial knowledge, it could be the retail knowledge, it could be a marketing team. Like you have to be thinking about every person that you're bringing into your small group as a value add. And so in the time we worked with them, they expanded into almost all Whole Foods. They got into Costco. They were in Target, Walmart. I mean, it was just an incredible growth story of like very, very efficient capital, really smart founders, and a clear white space in the assortment, right? I mean, who's touched the jam assortment for 20 years and no one thought we needed something new and better. But this is a good example where it's like when you have a really clear differentiation in the assortment, every retailer will want you, and you just have to figure out how you're going to lay the groundwork for each retailer and what the right strategy is. So they grew significantly. And then when they got to a certain point in scale, they went to a more proper ABL bank facility, which is 100% our goal for people is like, we're a bridge, right? We're here for you in that, 1 to 25 million. And when you get past that, that's when you want to start to go after and you're also more mature and you have more team to do all the reporting that's required for those type of facilities. So, yeah.
And just to go back to something you said earlier, you said kind of of the full journey, getting the PO written is the easy part, selling through is the hard part. Are there any operational or financial warning signs that a brand should be thinking about? Maybe there is a brand today that's listening that, hey, I've gotten my first PO. Maybe it's too many doors, or is it, hey, maybe there's some terms in it that I don't like. What are some warning signs for a brand that they may not be ready for retail?
The first one I've seen is they haven't run the full financial model and they're actually losing money with retail. So retail shouldn't necessarily be harmful to your total margin picture. You should be working through a scenario when it comes to terms, promos, slotting fees, all that stuff that actually does make sense for your business because it's not in the best interest of the retailer either. They don't want an unsuccessful brand that just paid them a ton of upfront cash that is going to be gone in 6 months and they're going to be fighting with anyway. So think about it that way. Think about like using the power of your innovation and your digital sales and what you built to get to a scenario that makes sense for both parties. That's my number one, right? So that's the beginning. Then you got to sell through and you want to hold back. You want to hold back as much as you can. So that's one reason you would use a Lunr too, right? If all of your dollars are sitting in your inventory at the time you set a target, what dollars are you going to use to drive promos, to make sure you're driving content, to build up a marketing campaign that actually, could be localized around the region in which you're selling? And so I think knowing the cash outlay over time and figuring out how you allocate that properly, and then know that you're going to promote your item. You're going to need to drive trial. What does trial look like in each store? These are the kind of things that people should be really, really, really thinking about. And again, I go back to your merchant or your broker should be helping you with a plan. There is not very many brands I've seen that can set on shelf and sell through with nothing. I mean, I'm trying to even think of one off the top of my head recently, like that I've seen. I think like maybe the one category where I've seen them sell is frozen because it's hard to promote. And frozen's an interesting one. You're behind a glass or all these things, or when something comes in really, really hot. But for the most part, even the hottest brands are still doing things to drive their sales at shelf.
Yep. I want to take a second to tell you about what we do at Hedgehog, because if you're a founder or operator listening to this, there's a decent chance this is relevant to you or someone you know. We work with consumer brands doing $5 million to $50 million in revenue who are navigating a special situation. That might look like a lender getting aggressive, capital stack that's gotten messy, revenue-based debt or Shopify Capital, MCA stacking on top of each other. It might be a retail transition that's bleeding cash, a board that's fractured, or a founder who's just exhausted and needs a second set of eyes. We buy, advise, or restructure. Sometimes that means coming in as a restructuring advisor to stabilize liquidity and run an exit process. Sometimes it means we acquire the business ourselves. We've done this 25 plus times now. Brands like Baboon to the Moon, Felix Gray, Rockets of Awesome, Nasolo, A Dozen Cousins, Koyo, Petplate, across apparel, food, CPG, footwear, accessories, personal care. If you're sitting in a situation that feels increasingly hard to manage alone, the cash is tight, the lenders are circling, and you're not sure what your options actually are, that's exactly the conversation we exist to have. Reach out directly to me at fan@thehedgehogcompany.com or find me on LinkedIn. The link is also in the show notes. Is there a view just on that point earlier about being profitable and kind of brand making money, merchant making money, or retailer making money, that there is a J curve into retail of like, hey, we can maybe lose money the first year or two, but as we get more expansion and that retailers' customers more familiar with us, or maybe there's some COGS reduction with scale. Like, is there any of that, or do you like, no, that's a sign for you're setting yourself up for a big trap?
So I used to think that, but now I have access to every single client of ours financials, and it's not the case. And I think you can't build a business on hope that margins will get better, hope that prices will come down, because guess what happens? Tariffs. Or, what I mean? Like, you can't see the future. So don't assume that that's going to happen. Or you're going to need to change the packaging. And that's going to be an expensive transition at year one. And that's going to be what brings your margins down. Or there's going to be a new regulation. No more dyes, and you're in California. I mean, there are so many things you can't see. So I would not build and assume that's ever going to happen. I would get the right financial structure set on day one. And then anything from there, you can't give up, but anything from there, efficiencies from like a supply chain, 3PL, et cetera, those can be added later and continue to, negotiate and grind down. But for the most part, it's day one. And that's another thing. I just think another misnomer is people used to think, well, when I sell it to big corporate CPG, they'll get those efficiencies, right? I'm going to go sell to General Mills and then they have huge. That's not even the case anymore. They're using co-packers too. They're using the same distribution network. So, again, don't think that someone's going to be interested in even acquiring your company down the road. As we both know, that's a whole nother conversation, which is getting ready to acquire, but it's like, you got to make money. So keep your eye on the ball, right?
Yeah. And speaking of making money, is there a tactic or piece of tech that's working especially well for clients right now?
Mm, it's a good question. I'm gonna go shout out to deduction management right now and the advancements we're seeing in technology around deduction management and what some of these companies like Glimpse have done to aggressively address the, picture between what you used to get paid, especially in these distribution models where there's a middleman between you and Whole Foods and what you're actually need to get paid. And this is me being negative, but I still think this is a place where retailers are getting it wrong. Like, I think retailers should set much clearer terms and distribution partners. They should be much clearer up front. There should be no question of what you're going to get paid. You should enter into a financial relationship with them of one of trust versus not trust. But I think this will continue this push around deduction management, the utilization of tech, making it easier will continue to push retailers to be better partners over time. And I think in the short term, they seem to be making big bucks for these brands. So I wouldn't shy away from them. I think I'd continue to learn. And I think AI is only going to make that a better and more interesting avenue for people.
Yeah, fascinating.
Hmm.
Is there a piece of advice that you'd have for founders heading into 2026 in terms of capital planning?
I would say stretch your runway. I still don't think we're quite out of this times of not knowing where the capital is going to come from. I think it's still a weird economy. I don't think these founders always think about where the funds come from like an equity perspective and fund perspective. I mean, there's a lot of options for them. They don't have to invest in venture. Venture is, very long to pay back these venture funds, and they're not necessarily guaranteed. It's a higher risk, higher reward situation. And so I would be thinking about your capital and be really taking a hard look at where you need to place risks and bets. And I would also be making sure I'm investing over time in the things that I know have a clear payback. So, I think if you can preserve capital and preserve months of the business is pretty critical right now. And, frankly, even from my side and from a venture side, cash is king. If companies have a lot of cash, it just gives everyone a little confidence that, they know how to spend it and they're wise about knowing when to put it aside and how to hold it properly. So,
It's not kind of full 21 exuberance. We're not quite back there yet.
mm-mm. And
Um,
I mean, I wonder if we'll ever be back there. I just told this story, but I did like a career day at my seventh graders school. And 6 months ago, when I always like go around and I have them write on post-it notes, like, if you could invest in one company today, what would it be? As a little like market research with these 12-year-olds. It was all things that they were doing, right? It was Starbucks, it was um, Nintendo, Roblox, those kind of things. Okay. 6 months later, I was there last week, handed out the Post-its. Guess what I got back? 90% of them said AI in some form factor. Could have been a specific AI, and I was like, wow, these are 12-year-olds. So if that's how they're thinking, I mean, you can only imagine how the market is feeling. They're thinking now, like, I don't necessarily believe that the future of Nike is as, productive as AI, obviously. So,
yeah. Yeah. No,
mhm.
totally. Aaron, as we wrap up, is there anything that you're seeking from listeners, types of brands that you want to talk to, maybe operators or collaborators?
I just love to talk to anyone who's having great conversations with retail. That's usually where we can add the most value, and we want to be helpful and we want to help build your right team around you beyond just the capital. So you can have success over the next, 3 to 5 years. And our team takes a very kind of consultative approach to even just having conversations. So anyone in that spot is in a great spot, and we'd love to chat with them.
Yeah, it certainly sounds like any brand that's thinking about going into retail for the first time, you're a very value add partner. So, Aaron, thanks so much for coming on and look forward to next time.
Thanks for having me.